Are you looking for a flexible, diverse, and cost-effective investment strategy? Have you ever considered exchange-traded funds, or ETFs? Stay tuned to find out why ETFs might just be the best investment strategy you've never tried. Hi, and welcome back to Money Matters, your trusted all-inclusive channel for making finance easy and exploring all things you should know about personal finance and investing. Today we're going to delve into the world of exchange-traded funds, or ETFs, and explore why they might just be the best investment strategy you've never tried. ETFs have been gaining popularity among investors for their flexibility, diversity, and cost-effectiveness. But what exactly are ETFs, and how can they fit into your investment strategy? Whether you're already familiar with ETFs or hearing about them for the first time, stick around as we unravel the mystery of ETFs and how you can leverage them to optimize your investment portfolio. But before we dive into the world of ETFs, if you're new here, don't forget to hit that subscribe button and ring the bell to stay updated with all our latest content. And if you find this video helpful, be sure to give it a thumbs up. Also, don't forget to share this video with someone who also could benefit from this info, so they stay updated as well. Now let's get started. What are ETFs? Now that we've set the stage, let's dive into the world of ETFs. What exactly are they? Exchange-traded funds, or ETFs, are a type of investment fund and exchange-traded product traded on stock exchanges. ETFs are similar in many ways to mutual funds, but they are traded on the stock market as if they were individual stocks. They're designed to track the performance of a specific index, sector, commodity, or asset class. They can be bought or sold throughout the day, just like regular stocks, and they have a ticker symbol, just like stocks. Now take a moment to reflect on your current investments. Have you considered ETFs in your portfolio? Or maybe you're already investing in them. So, ETFs are a versatile and accessible investment vehicle. But what makes ETFs so special? Why are they becoming increasingly popular among both new and experienced investors? Let's find out in the next section, the benefits of ETFs. We've understood what ETFs are. Now let's explore the benefits that make them a popular choice among investors. One of the main reasons ETFs are becoming increasingly popular is because of the numerous benefits they offer. Firstly, diversification. ETFs allow you to invest in a wide range of assets at once, reducing the risk associated with investing in a single company or sector. Secondly, flexibility. Unlike mutual funds, which can only be bought or sold at the end of the trading day, ETFs can be traded throughout the day like stocks. This gives investors the flexibility to react to market changes in real time. Thirdly, lower costs. ETFs generally have lower expense ratios compared to mutual funds, which means more of your money goes towards your investment rather than fees. Lastly, transparency. ETFs disclose their holdings daily, allowing investors to know exactly what assets they own through their investment. Now take a moment to reflect on these benefits. Could ETFs be the missing piece in your investment strategy? While ETFs offer numerous benefits, they also come with certain risks. Let's delve into those. Risks of ETFs. Just like any investment, ETFs also come with their own set of risks. Here are a few you should be aware of. Market risk. This is the risk that the market will decline, which can lead to losses in your ETF investments. For example, if you're invested in an ETF that tracks the S&P 500, like the SPDR S&P 500 ETF Trust, SPY, and the S&P 500 index declines, the value of your ETF will also decline. Liquidity risk. This is the risk that you may not be able to buy or sell your ETF shares quickly or at a fair price. While most ETFs are highly liquid, some ETFs that track less popular indexes or sectors may have lower trading volumes, which can increase the spread between the bid and ask prices and make it harder to buy or sell shares without impacting the price. Tracking error. This is the risk that the ETF will not accurately track the performance of the index it's supposed to mimic. This can be due to a variety of factors, including the ETF's expenses, the method the ETF uses to replicate the index, and the timing of dividend reinvestment. Management risk. This is the risk that the ETF's manager will not execute the ETF's stated investment strategy effectively, which could lead to underperformance. Currency risk. If you're investing in an ETF that holds foreign securities, you're also exposed to currency risk. This is the risk that changes in the exchange rate between the US dollar and the foreign currency will negatively impact your investment. Remember, while ETFs can be a great tool for diversification and can offer exposure to a wide range of sectors and asset classes, it's important to understand the risks involved. Always do your research and consider your own risk tolerance and investment goals before investing. Now, take a moment to reflect on these risks. Are you comfortable with them? Do they align with your risk tolerance and investment strategy? Now that we've covered the risks, let's see how ETFs stack up against another popular investment vehicle, mutual funds. ETFs versus mutual funds. ETFs and mutual funds are often compared. Let's see how they stack up against each other. ETFs, or exchange-traded funds, and mutual funds are both types of investment funds, but they have some key differences. Trading. ETFs are traded on an exchange like individual stocks, which means they can be bought and sold throughout the trading day at market price. On the other hand, mutual funds are bought and sold at the end of the trading day at the net asset value, NAV price. Management. ETFs are typically passively managed and aim to track a specific index. This is not always the case, but it's a common characteristic of many ETFs. Mutual funds, on the other hand, are often actively managed, meaning a fund manager makes decisions about how to allocate assets in the fund. Minimum investment. ETFs generally have no minimum investment requirement. You can buy as little as one share. Mutual funds, however, often have minimum investment requirements. Fees. ETFs generally have lower expense ratios than mutual funds. For example, the FlexShares US Quality Low Volatility Index Fund, QLV, has an expense ratio of just 0.22%. This is because ETFs are usually passively managed. Mutual funds, being actively managed, often have higher fees. Transparency. ETFs disclose their holdings on a daily basis, while mutual funds disclose their holdings quarterly. Remember, whether an ETF or a mutual fund is better for you will depend on your individual circumstances, including your financial goals, risk tolerance, and investment strategy. Now take a moment to reflect on your own investment strategy. Are you more drawn to the flexibility and lower costs of ETFs? Or do you prefer the active management and potential for higher returns with mutual funds? With a clearer understanding of how ETFs compare to mutual funds, let's move on to how you can choose the right ETFs for your portfolio. How to choose the right ETFs. Choosing the right ETF can seem daunting, but don't worry, we're here to guide you through it. When it comes to choosing the right ETFs, there are several factors you should consider. Investment objective. The first step in choosing the right ETF is to understand your investment goals. Are you looking for growth, income, or a combination of both? Different ETFs are designed to achieve different objectives, so it's crucial to choose one that aligns with your goals. Expense ratio. This is the annual fee that all funds or ETFs charge their shareholders. It's important to consider because it affects your returns. A lower expense ratio could mean higher returns for you. Diversification. ETFs allow you to invest in a broad range of assets, which can help reduce risk. Look for ETFs that offer a good mix of different types of investments. Performance history. While past performance is not an indicator of future results, it can give you an idea of how the ETF has done in different market conditions. Liquidity. ETFs that are traded more frequently tend to have lower spreads between the bid price and the ask price. This means you're more likely to get the price you want when you buy or sell. Fund size. Larger funds can often operate more efficiently than smaller ones, which can result in lower costs for investors. Now let's look at some examples of ETFs that meet these criteria. FlexShares U.S. Quality Low Volatility Index Fund, QLV. This ETF has an expected return of 9.58% and an expense ratio of 0.22%. It's diversified and pays dividends. SP Funds S&P 500 Sharia Industry Exclusions ETF, SPOES. This ETF has an expected return of 11.11% and an expense ratio of 0.49%. It's also diversified and pays dividends. Wahed FTSE USA Sharia ETF, HLAL. This ETF has an expected return of 10.75% and an expense ratio of 0.50%. It's diversified and pays dividends. Remember, I'm not a trained financial advisor, but merely an educator. It's essential to do your research and consider your financial goals and risk tolerance before investing in any ETFs. Now, I want you to think about this. Are these ETFs aligned with your investment strategy? How do they fit into your current portfolio? Consider their performance, expense ratio, and diversification. Take a moment to do so. Now that you know how to choose the right ETFs, let's discuss how you can start investing in them. How to invest in ETFs. If you want to quit babbling and get to it, investing in ETFs is a pretty straightforward process. Let's walk through it step by step. First, open a brokerage account. If you don't already have one, you'll need to open a brokerage account. There are many online brokers to choose from, each with their own features and fees. Next, research ETFs. Use the factors we discussed earlier to find ETFs that align with your investment goals. Many brokerage platforms offer research tools to help you compare different ETFs. Then, buy ETF shares. Once you've chosen an ETF, you can buy shares through your brokerage account. ETFs are traded like stocks, so you can buy and sell shares throughout the trading day at market prices. Finally, monitor your investment. After purchasing ETF shares, it's important to regularly review your investment and make adjustments as needed based on your investment goals and market conditions. Now take a moment to reflect on this process. Do you feel ready to start investing in ETFs? Or are there any steps you're unsure about? Maybe you want to cut ahead and get to it? Here are some ETFs that are worth taking a look at. Disclaimer: once again, I'm a financial educator, not a trained advisor. I do not hold accountability for your portfolio. These are simply some ETFs I searched out as examples. I've already mentioned these ETFs when we discussed which ones meet the criteria to be worth considering. Remember, it's essential to do your research and consider your financial goals and risk tolerance before investing in any ETFs. So once again, ETFs you might want to look at are FlexShares U.S. Quality Low Volatility Index Fund, QLV. This ETF has an expected return of 9.58% and an expense ratio of 0.22%. It's diversified and pays dividends. SP Funds S&P 500 Sharia Industry Exclusions ETF, SPOES. This ETF has an expected return of 11.11% and an expense ratio of 0.49%. It's also diversified and pays dividends. Wahed FTSE USA Sharia ETF, HLAL. This ETF has an expected return of 10.75% and an expense ratio of 0.50%. It's diversified and pays dividends. And there you have it. You're now equipped with the knowledge to start investing in ETFs. Let's wrap things up. Conclusion. And that's a wrap on our deep dive into the world of ETFs. We've covered everything from what ETFs are, their benefits and risks, how they compare to mutual funds, and even how to choose and invest in the right ones. ETFs can be a powerful tool in your investment arsenal, offering a balance of risk and reward. They offer a unique blend of diversification, flexibility, and cost-effectiveness that can help both new and experienced investors build a robust and efficient portfolio. However, like any investment, they come with their own set of risks and considerations. It's essential to do your own research, understand your financial goals, and consider seeking advice from a financial advisor before diving in. Remember, the key to successful investing is knowledge, patience, and diversification. The world of finance is vast and ever-changing, and the key to navigating it successfully is continuous learning and adaptation, which is exactly what we're here for. As we wrap up, we hope you found this video on ETFs helpful. If you did, think about someone who might also benefit from this info. As you see, financial knowledge is of critical importance, especially in today's world. After all, we don't have our name for nothing. Money does matter. If you got someone, share it with them so they don't miss out. We'd love to hear your thoughts, so feel free to leave a comment below. If there's any topics you'd like to know more about, be sure to drop them in the comments. Your feedback helps us create content that serves your needs. Don't forget to like, comment, and subscribe to stay updated with all our latest videos. We have a lot more informative and exciting content planned for you. And that's all for today. Thank you for watching and investing your time with us. We hope to see you again next week here at Money Matters, because your money matters.